2021, the Federal Reserve earned $107.8 billion. Here is the part nobody tells you. It kept almost none of it. $107.4 billion went straight to the United States Treasury. The private banks that supposedly own the Federal Reserve received $583 million, about half of 1%. If the Fed is a secret private cartel printing money for its owners, it is running the worst heist. Financial history. So what is it actually? The Federal Reserve is the most powerful financial institution on Earth and the most misunderstood. In the next 10 minutes, you will know exactly who owns it, exactly how it sets the price of every dollar you borrow, and exactly how that reaches the check you write for rent. 3 questions. 1. Who actually owns this thing and who collects the profits? 2. What does it actually control, because it is far less than most people think? 3. How does a decision made in one room in Washington end up inside your rent? Hold on to number 3. That one has a twist you will not see coming. Start in 1907. A banking panic tears through New York. There is no central bank, so the country has to be rescued by one man's private fortune, with J.P. Morgan personally locking bankers in his library until they agreed to a bailout. Congress decided no nation should depend on that. 6 years of argument later, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act. Now the ownership question. People will tell you the Fed is secretly private. Here is the Federal Reserve's own answer, published on its own website. The Federal Reserve System is not owned by anyone. That sounds like a dodge. It is not. It is the literal legal answer, and the real structure is genuinely stranger than the conspiracy version. The system has 2 halves. The Board of Governors in Washington is a federal government agency. 7 governors, nominated by the President, confirmed by the Senate, serving staggered 14-year terms. Then there are 12 regional reserve banks: Boston, New York, Chicago, and 9 others, and those are chartered like private corporations, with stock held by member banks. That second half is where the conspiracy lies, so look closely at the stock. If a bank wants to be a member of the Federal Reserve System, it is required by law to buy stock in its regional reserve bank, equal to 3% of its own capital. But this is not stock in any sense you understand the word. The bank cannot sell it. It cannot trade it. It cannot pledge it as collateral for a loan. And it buys no control over monetary policy whatsoever. It is a membership fee that happens to look like a share certificate. What it does carry is a dividend, and the dividend is set by statute, not by profits. 6% a year for banks with $12.5 billion or less in total assets. For the giants above that line, they get the lesser of 6% or the yield on the most recent 10-year Treasury auction, whichever is smaller. In 2021, every one of those dividends added together came to $583 million. Now put that against $107.8 billion in earnings. More than 99% of the money went to the United States Treasury, which means to the federal budget, which means in the most literal sense available to you. By law, the reserve banks are not operated for profit, and everything left after expenses, that fixed dividend and a capped surplus, goes to the government. That is the complete answer on ownership. And control follows exactly the same pattern. Interest rates are set by the Federal Open Market Committee, 12 votes. 7 of them belong to the presidentially appointed Senate-confirmed governors. 5 belong to Reserve Bank presidents, and only one of those 5, New York, votes at every single meeting. Government appointees hold the permanent majority. The banks do not. So what is this committee legally required to do with that power? Not enrich anyone. Congress wrote the job description directly into the statute in 1977. Promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. People call that the dual mandate, jobs and prices, even though the statute plainly lists three goals. And notice the tension welded into it. Fighting inflation means making money expensive, which costs jobs. Protecting jobs means making money cheap, which risks inflation. Every single rate decision is that trade-off, argued out in public 8 times a year. Which brings us to the mechanism and to the biggest misunderstanding in personal finance. The Federal Reserve does not set the interest rate on your mortgage. It does not set your credit card rate. It does not set your car loan. It sets exactly one thing: the price of overnight money between banks. Everything after that is a chain reaction. Here is the chain. The committee announces a target range for the federal funds rate. Today that range is 3.5 to 3.75%. That moves what banks charge each other overnight, which moves the prime rate, which moves credit cards and business loans almost immediately. But your mortgage is a 30-year loan. It does not track an overnight rate. It tracks the 10-year Treasury yield, which is the bond market's collective bet on where rates and inflation are heading for the next decade. So the Fed influences your mortgage. It does not set it. This is why you will watch the Fed cut rates and see mortgage rates go up in the same week, because the cut was already expected and priced in months earlier, or because the bond market decided inflation risk just got worse. Confusing those two things is the most common mistake in financial commentary, and now you will never make it again. As of June 2026, the average 30-year fixed mortgage sits at 6.48%. In 2021, it was under 3%. On the same house at the same price, that gap is hundreds of dollars a month every month for 30 years. Nothing about the house changed. Only the price of the money did. Now the part you actually feel. Expensive money reaches your rent down 2 separate roads, and they run on completely different clocks. Road 1 is fast. Buying gets expensive, so would-be buyers stay renters, demand for apartments rises, and rent goes up. Road 2 is slow. Developers borrow to build. Expensive money means fewer buildings get financed, so future supply shrinks. That pushes rent up too, but years later. And you can watch Road 2 happening in the data right now. In 2023, at the peak, nearly 1 million apartment units were under construction across the United States. By 2025, that number had fallen to 686,000, with 416,000 new units started that year. The pipeline is draining in public, 1 quarter at a time. Here is the twist, and it is the exact opposite of what you would expect. Rents right now are not spiking. In the 4th quarter of 2025, rents on professionally managed apartments actually fell, down 0.6% from a year earlier. Why? Because the buildings that were financed back when money was cheap are finishing construction now. The supply finally arrived. That lag is the whole lesson. A rate decision does not hit your rent this month. It hits the buildings that get financed this month, and those buildings open their doors 3 or 4 years from now. Today's soft rents were bought with cheap money in 2021, and today's expensive money is quietly deciding what your rent looks like in 2029. And that delay matters enormously because there is no cushion left to absorb it. A record 22.7 million renter households, 49% of every renter in the country, now spend more than 30% of their income on housing. 12.1 million of them spend more than half. None of this puts the Fed above criticism. There are real arguments against it, and they are far better than the fake one. It is deliberately insulated from voters, with 14-year terms and funding from its own securities income rather than from Congress. Its main tool works by slowing the economy down, and the people it slows first are renters, borrowers, and young buyers, not asset owners. And it is not infallible. In fact, it is currently losing money, and a staggering amount of it. When the Fed raised rates, it started paying out more interest on bank reserves than it earns on the bonds it holds. Those accumulated losses now sit on its own books as something called a deferred asset, worth $244 billion. Remittances to the Treasury are suspended until that hole is filled. So here is the honest scoreboard. It is not privately owned and it is not run for profit. The numbers make that completely unambiguous, but it is genuinely unelected, genuinely powerful, and its mistakes are genuinely expensive. Those are two entirely different criticisms, and only one of them survives contact with the evidence. Knowing which is the whole point of this channel. Next week, why the rich buy assets and the poor buy liabilities. The single decision that separates the two and how the exact machinery we just took apart is what makes it work. If this changed the way you look at the number on your lease, subscribe. And the other mechanics channels are linked in the description if you want the same treatment applied to empires, to mastery, and to what is coming next. Read the machine.